So yeah, so this presentation I think is very valuable because it not just helps you put money into your pocket, also helps you take years off your mortgage. So Carmelo Buttice is a mortgage broker of mortgage agent of your mortgage your way. He spent over 20 years in the mortgage industry. He's going to be sharing some of his knowledge. So Carmelo, take it away, please.
So just to begin, I want to let you know every individual here, just a little disclaimer, has their own goals and time frame and objectives. The information I am sharing is going to be for educational purposes. It is recommended that you make your financial decisions based on your own goals and your own budget. So again, to begin, welcome everyone for joining us tonight. My name is Carmelo Buttice. I'm a mortgage agent at yourmortgageyourway.ca. I've been doing mortgages. I forgot the year I started. I've been doing it for over 20 plus years. I began my career as a mortgage underwriter, and I worked for the big banks, the small alternative lenders, and now I'm independent. Anyone can contact me at carmelomortgage@gmail.com or at Instagram at carmelomortgage. So to begin, there's really three ways that are the most common ways that you hear in media when you talk to your bank or you talk to another mortgage agent or broker of how to pay off your mortgage faster. I'm going to be sharing these and kind of breaking them down. At the end, I'm going to be sharing two little hidden secrets. These two secrets are things that I personally do. So if you have questions, let me please go through the presentation deck, and Alex, okay, and maybe answer one or two things that you have. But by the time I go through everything, hopefully I'll be able to explain how to pay off your mortgage faster. So there's three ways to pay off your mortgage faster. The first thing you could do is you could change the frequency of your payments. The second thing you could do is you could increase your payments. And the third thing you could do is make a lump sum towards your principal throughout the year. And I'm going to kind of break down every one and show how it all works. So the first thing and the easiest thing to do to pay off your mortgage faster is change your payment frequency. All the banks, when they approve a mortgage, they typically approve it based on a monthly payment. If you simply change that monthly payment to biweekly accelerated, you'll save years off paying off the mortgage. You'll save years off your amortization. And just I want to give this example, not to say that these are the rates that are going to be going on forever for the next 25 years, but today, let's say you get a mortgage, $500,000, and your rate's 5.49%. You get it with a 25-year amortization. Now, you have different payment frequencies. You could choose between monthly, semi-monthly. A lot of people ask for biweekly payments, but the key thing is you need to get biweekly accelerated payments. The difference is when you have your payments biweekly accelerated, you're effectively making 13 monthly payments in the course of a year. There's only 12 months in a year. And the breakdown is, again, when you look at it, if your payments begin with $500,000 mortgage, 5.49% interest rate, 25-year amortization, your payments begin at $3,049. Let's just say $3,050 per month. When you change your payments frequency to just semi-monthly, it cuts that payment in half. Doesn't really change anything. You're not really increasing your payments. You're not doing anything to pay off the mortgage faster. You do save technically a little bit of interest over the course of the 5 years because you make your payments a little bit more frequently, but the amount is the same. You're only going to be saving around $247 or $37. Now, a lot of people when I work with, they ask for biweekly payments, and this is where they get confused. And when I ask them, do you want your payments biweekly or biweekly accelerated?
Yeah, or even semi-monthly, like, isn't that the same thing?
No, semi-monthly is just twice a month, say the 1st of the month and the 15th of the month, or the 15th and the 30th of the month. Okay. Right? Because you change your payments to semi-monthly, you're going to only be making 24 semi-monthly payments in a year. Bi-weekly is where it kind of people get confused because people just think, oh, I want to make my payments every 2 weeks and it's going to pay off my mortgage faster. Well, how the banks, when the banks hear bi-weekly, they take that monthly payment, they multiply it by 12 to give them an annual amount of what the payments are. And then because there's 26 bi-weekly payments in a year, they take that annual amount and divide it by 26. Therefore, you have a payment that's bi-weekly. So a $3,149 payment comes to $1,407. That doesn't really do much when it comes to paying off your mortgage. You will save 1 month on the amortization. You will save maybe $270 in interest. but it doesn't help you pay off your mortgage faster. It's having the payment bi-weekly accelerated. So what that means, it means it takes that monthly payment, it divides it by 2, and because there's 26 biweekly payments in a year, you're really making 13 monthly payments in that year. Doing a small thing like this could reduce your amortization from 25 years to 21 years in 3 months. What do you think, Alex?
So you're making, sorry, I think you mean you're making 26 payments, right? Not 13.
Well, 13 monthly payments. You're making 26 biweekly payments, but there's 26 biweekly payments in a year.
Mm-hmm. Well, that's substantial. So like this example here, by just doing this, it looks like you shaved off 3 years and 9 months off your
Yes.
mortgage
Yes.
just by doing that.
That's pretty smart, actually, because you're paying 15 days in advance, so you're paying faster.
Mm-hmm.
It's the biweekly accelerator. It's increasing that payment, because again, instead of paying say $3,050 per month, you're paying $1,525 every 2 weeks.
Yeah, I understand what you mean, and I know how the math will work. No, it's pretty smart. I never thought that.
This is the simplest thing everyone could do, and
Yeah,
I always recommend with people, if you get paid biweekly, all the people I work with, just have your monthly payment, mortgage payment come out the same day as your pay, or maybe the next day, right? Some people do get paid on a Thursday. Just have the payment come out the same day, so money comes in, money goes out. You already know your mortgage is covered, and now you could budget with what you have remaining.
Yeah.
And how much you're saving? How many years you're saving?
3 years and 9 months.
Wow.
Just by doing that. So
Just by
taking
doing
that semi-monthly amount, 1525, but making it bi-weekly and then increasing it, right? Is that what it is?
the biweekly automatically increases the payment, Alex.
Mm-hmm.
Right? When you go biweekly accelerated, it's just taking that monthly payment, it divides it by 2.
Hmm.
Keep it simple. It's not just, it takes that monthly amount, it divides it by 2, and that's biweekly accelerated.
Yeah.
So,
Thank you. I'm going to do it right away.
again, the results are, again, changing your payment from monthly to biweekly accelerated saves you $2,500 worth of interest during the 5 years and helps you pay off the mortgage 3 years and 9 months faster. Very, very simple tip.
That's almost like an extra payment. Because in your example, it was what was
Yes.
the amount?
Yes. It's almost a full payment, but it's that amount. It's years off the mortgage. Not having to pay a mortgage for 3 years and 9 months in advance. How many payments is that, Alex? That's a lot of money.
12,
So the next thing is, the second thing you could do with your mortgage is that you could also increase your payments. Now, I always recommend with my customers, if you're buying your first home, for the first 6 months, 9 months, you don't necessarily have to rush to increase that payments, because if you're buying your first home, you're going to have a lot of one-time expenses. You need to buy vacuums, carpets, cutlery, paintings, linens, sofas, things for the first time. But afterwards, increase your payment to the closest $100. That's what I always kind of recommend, because it's something that's kind of more affordable. So all I'm going to do is I'm going to provide 2 examples. Now, we change your monthly payment to biweekly accelerated. So your payment is $1,525. Let's just say you want to round up your payment to the nearest 100, $1,600 biweekly. What does that do? Well, then it further reduces that amortization from 21 years and 3 months to 19 years and 6 months. It takes off another 1 year and 9 months to pay off your mortgage. A small little increase of $75 every 2 weeks.
It's nothing.
It's
very substantial.
It's very, very affordable. Now, again, I do work with some people who want to be a little bit more aggressive. And the key thing is, you have to look at can you afford it? The last thing I recommend with everyone I work with is you want to be house rich and cash poor. But I did want to provide an example. Let's say you increase your payments to $1,800. My calculator just rounded it to $1,801. You do something like this. Now you take that amortization of 21 years and 3 months. It reduces it already down to 16 years.
It's almost what is that? You cut basically by doing that, you cut it to 2/3.
Well, you started with 25 years, you took off 9 months. That's what, 40%?
Yeah, you took out.
Sorry,
you
I
took
didn't
off
get
10
that.
years.
Can you repeat that?
So some people I work with are a little bit more aggressive when it comes to increasing their payments. Because with all the banks I work with, you could increase your payments by anywhere from 10%, 15% to 20% of your original mortgage amount. So
Okay.
if you increase your payments from 1,525 to 1,800, your amortization then gets reduced to 16 years.
Yeah.
So
Yeah.
you buy a property, you get a mortgage. Technically, you could do this within the first month. And again, everyone's focused on, oh, my mortgage is a 25-year amortization. Well, you do these 2 little steps right away. It's only going to take you 16 years if you're going to be really aggressive in increasing that payments. So you
And
do.
if you find yourself that you're too aggressive, you can always scale it back. I'm assuming, right?
It depends on the bank you work with. Some banks will allow you, some banks will not. The key thing is, again, do something that's affordable. You don't want to be changing your payment frequency or your payment amount all the time. It's easier to increase it slowly than pulling teeth with a bank to get the payment reduced. I've done it with my mortgage personally. I know it can be done. And I know it can be done. It's not done available with all the banks, right? So the key thing is you want to stay within budget. And again, rounding it to the nearest $100, taking that payment from 1,525 to 1,600 biweekly. Again, $75 biweekly is something that's a little bit more affordable, Alex. Right? You may not even notice that coming out.
Yeah, it's just that's like a coffee a day type of thing.
Yeah, it's just, it's as the payments come out of, when the mortgage payments come out the same day as your pay stub and your income comes in, you won't notice $75 coming out every 2 weeks. You'll still be able to live within a budget. You're not going to be constrained where you can't go out and you can't do that trip, or you can't go for dinner with your friends or something like that. $275 increase, that's a large amount. So the second tip to pay off your mortgage faster is simply increasing your payments, because as a reminder, when you increase your payments, whether it's $75 or $275, for every dollar you increase your payment, that goes directly towards the principal. Every single penny. So the results, you increase your payments regardless of how much. You can pay off your mortgage faster, adding a small increase of $75 biweekly as an additional $1,436 in interest savings. When you add that to the first savings you got when you change your payment from monthly to biweekly accelerated of $2,500, now you saved a total of over $3,900 in the first 5 years. At the same time, you're paid off your mortgage 5 years and 6 months faster. Pretty simple, Alex, is it not?
It's very simple.
Yeah.
Very, very approachable.
So the third thing is, again, lump sums. If you're if with your employer, if you know you get bonuses every year, you get tax refunds every year, use your bonuses, your annual bonuses, use your tax refunds to put a lump sum on your mortgage. Remember, this is the bonus. This is income you're not expecting. So use it to your advantage. I want to kind of give this example, 2 different amounts. Remember, we started originally with a mortgage of $500,000 at 5.49% and a 25-year amortization. Now we decided to increase that payment from monthly to biweekly accelerated, and we increased it just a small amount of $700 every 2 weeks. This $1,600 biweekly. That's your payment. If you were to just put small annual lump sums of $500, what that does, it reduces 5 months off the amortization. It's not going to break the bank, but remember, you're only putting in $500 as a lump sum every year. If you're a little bit more fortunate, you get good bonuses with your employer or good tax refunds. Let's say you're able to put $5,000 toward your mortgage every year. Well, now you're reducing another 3 years and 4 months off your amortization. So if you're putting lump sums on your mortgage, everyone wants to focus, what's the maximum I could do? Well, the maximum is going to be based on, well, where's this money coming from? think about the easy things you could do. Annual bonuses at work, tax refunds, small or large. Any amount of money you put as a lump sum towards your mortgage goes directly towards the principal. Therefore, every payment afterwards, you're paying less interest.
When can you actually do this? Can you put lump sums anytime?
Some banks allow it on the anniversary, the anniversary year. So if you got your mortgage, say May 1st, it'll be every May 1st. Some banks will allow you to do it multiple times throughout the year. I was able to, with one of my previous bank, I was able to do it. I think I did it 4 or 5 times throughout the year. I did well with my sales. Okay, I got a little bit of extra money. I put a lump sum down. When I got it, I didn't get a tax refund. I had to pay taxes that year. But when I got, you know what I mean? Little bonuses. I had an investment that went my way a little faster and made a little bit of money off the stock market. Put a lump sum down. There's many ways. I do a lot of separate little tricks, but you're able to put down lump sums either once a year or multiple times, as long as it doesn't exceed your allowance.
Okay.
What I mean, Alex, with an allowance is, let's say you're start 500,000. Some banks will allow you to put 15%, which would be 75,000 each year. Some banks will allow you to put 20%, which is 100,000 each year. Most people I work with don't have an extra 75,000, 100,000 per year. Focusing on which bank will give you the maximum lump sum really doesn't make that much sense, because who's got 100,000 a year? If you got 100,000 a year, you're most likely looking for a bigger mortgage to buy a bigger property.
Does every lender allow this, or there are some lenders that don't?
Every lender allows this.
So every lender allows you to accelerate your payments. Every lender allows you to increase your payments. Every lender allows you to put a lump sum. It's just like how much and how frequently is the only variable.
Exactly.
Yeah. Significant. And this is just with your $1,600 example. Imagine you did the accelerated biweekly at $1,800 in this. I figured that effective amortization rate would be maybe somewhere around 12 years.
Maybe 13 or 14. It's really, again, I want to kind of tonight show an example based on, things that are a little bit more achievable, right? Small increments, $75, $500, $5,000 is pretty reasonable, even though it's still a lot of money for me, right? So these small little things, when you take off the years off the mortgage, Alex, again, like, let's just take that $500 lump sum. You paid off your mortgage 5 years, 11 months faster. I don't need to get a calculator out. If you're saving $1,600 every 2 weeks for almost 6 years, you're probably going to be in the 6 figures, right? You don't have to make 6 figures worth of payments. That's where I find the savings in. Not so much how much interest on my savings. It's now my mortgage is done with. I don't have to pay it anymore. I'm free. I'm free from the bank.
Do you find that a lot of consumers do stuff like this?
A lot of consumers I work with, yes. Because again, I kind of give a bunch of these recommendations, specifically that bi-weekly at the very beginning when they get their mortgage. Putting the increase in your payments, as in every first-time buyer, Alex, I always recommend that when I follow up with them 6 months or a year later about not increasing that payment right away. When you're buying your first home, or even you're leveling up and you're buying a bigger home, the first 6 months you can have a lot of one-time expenses. Garden stuff, winter stuff, bigger rugs. If you got a bigger house, more appliances, more furniture. You may want to just you may want to renovate it, do small renovation touch-ups and paint the house again. In the first 6 months, you're going to incur a lot of one-time expenses. So in the increasing that payment, I don't recommend necessarily always doing it right away, because you want to have that extra money to do those things. Once the house is painted over again, you did those minor repairs, you got the new one-time expenses, you got a new barbecue, or you got a new sofa or TV or items like that, then, okay, those big expenses are gone. You never have to do them over again for multiple years. That's when you increase your payments. The bonuses and the annual, that is the kind of something I kind of like to go explain every time, because that's just whenever you get your bonuses. That mean everyone I work with, they get their bonuses different times of the year. I'm sure everyone here, if you were to put in the chat group the month you get your bonus, we're going to get different months. But these are the three most common things when it comes to paying off your mortgage faster.
Nice.
So as a result, you do this. Let's just say you're the fortunate person. We could change your payment from monthly to biweekly accelerated. You're able to increase your payment $75 biweekly, and let's just say you're able to put in an additional $5,000 every year as a lump sum. You saved. Oh, damn! I think I made a typo there. It should be 8 years and 10 months faster. Sorry about that. I'll have to correct that for next time.
I'll remind you.
So that's the most common things, which I wanted to share tonight. But after 5 years, you lived in your home, you still got $389,000 balance left on your mortgage. That's still a lot of money, Alex.
Yeah. So we need some other strategies here. Some other secrets.
So I have I call them hidden secrets because these are things that I do. Because I've done the math. I looked at it. And it's like, that's a lot of money. I don't want to still pay, 18 years to pay off my mortgage. It's a lot of time too. So again, I want to kind of share two hidden secrets. These are things I've done. And for those who've watched previous presentations we've done, I already know what these are. So first and foremost, did you know, Alex, you could actually buy a home with 100% financing, no down payment?
I didn't know that. This picture is very clear, by the way.
Oh yeah, it gets pixelated because it was really small. I got to find a new one with a better quality image. But
no, but I didn't know that. I thought that was just like a US thing or just one of these. Yeah, we'll teach you how to do this. Just sign up for our master class.
Yeah, no, this is where I personally bought a property with no money of my own down payment.
Okay, I know where you're going now that you.
So, you got your mortgage. After 5 years, you've balanced with $389,000. What do you do? Well, first thing I did is I lowered my mortgage payments. Then I set a goal of how fast I want to pay off my mortgage. I look at the new amortization schedule to estimate how much my balance will be on my mortgage for the date of of whatever my goal is. Everyone here is going to have a different goal, so you have to figure out a goal that works for you. And if you want to be, the more aggressive you are with that goal, the more risk you may be taking on as well.
Okay, hold on. So you lowered your mortgage payments?
I lowered my mortgage payments.
Can you just repeat the scenario again? What do you mean you lowered your mortgage payments?
When I first bought my property, I increased my payments. I put lump sums on my mortgage. I accelerated everything.
Okay, and then you renewed your mortgage after 5 years and you lowered the payments. I
lowered my payments.
Okay.
I need the extra cash flow. So I'm looking at buying another property.
Okay.
Now, the interesting thing is, this is a fun fact. From 1977 to 2022, real estate in GTA increased by 1,841%. That comes out to 18.5% compounded annually. Now, let's just remove some years. Let's go over the past 20 plus years, from 2000 to 2022. The value of real estate increased 489%, or 19.3% compounded annually. Those are crazy numbers. And for those who don't believe me, I got this all from Treb.
So is what average sale price? Yeah, 64,000 in 1977.
And 2022, 1.189 million.
Yeah.
Just crazy. So how to pay off your mortgage faster is you can look at buying real estate, and you can buy real estate with no down payment out of your own pocket. Set your goals. Set your goals with how fast you want to pay it off. I gave an example, 8 years. I know 8 years, use the same calculator. I know if I go on the same amount, I know rates will change because, again, my term is 5 or 3 or 2, whatever I do, and it resets. But you have to have some assumptions. And I'm not going to go base, Alex, that real estate's going up by like 18, 19%.
We never do. We usually do like 5 or 10 in our examples.
I'm going to use a third. Because again, the time frame obviously is a lot shorter. I'm using 8 years versus comparing 20 years or 50 years or 40 years. Like I use 6.5% per year. Decide to also, you refinance your home. That's how you get your down payment. And you use that money to buy another property. So you're buying a property for say 600,000. Assuming the real estate goes up 6.5% every year. In 8 years, that property is going to be worth 993,000. Now, after the 8 years, the money you borrowed, because again, remember, Alex, you're borrowing a full 600,000. You're taking equity out of the home you live in, plus the new money you're getting from the bank. You borrow, after 8 years, the balance you have on your mortgage is just over or just under $520,200.
Yep.
The value is 992. Let's say 993. You subtract your mortgage balance, you got a profit of $472,800
in equity.
profit. So it's a little straight line. Forget about I'm going to get into the cost with buying and selling and all of that as we move along. I want to keep it as simplest as possible.
Yeah, this is a great example. Yeah, anybody, that I think that if you have significant equity sitting in your home and you're not doing anything with it, it's essentially just dead money.
It is dead money. So I chose to take equity out of my home to buy investment property. Those who joined us a few weeks ago, Alex, when we did that, the second part 2 of how to invest in investment property, I showed how I took equity out of my property, and I showed how, a few years later, I refinanced that property to get my money back.
Yeah, that was a good example. You guys bought that property. Really, the timing was good because the market just accelerated, like over the course of almost a year after you bought it. Like it just significant appreciation, and you had a good opportunity to do that. But I know what you're talking about. In that same webinar, I also have done this as well. I just didn't refinance and pay myself back.
Yeah. So again, this example is based on, I got really lucky. This example is based on the average appreciation, right? Some years are going to be quicker than others. This year, we may get a couple points up in percentages. We may be flat. It's going to average out. But if you just buy a property for 600, use that assumptions, 6.5% gain every year. After 8 years, you're going to have a profit of $472,800.
Yeah,
now,
we usually talk about holding properties, at least for chunks of 5 years.
5 years is minimum.
Yeah.
Yeah. So
to allow appreciation, I don't think there's, like, when we look back at Trev, when we look at the charts, like, I don't think we ever see a 5-year period where somebody is not significantly better off with that purchase, regardless of when they bought it. Even somebody that maybe bought it at the peak of like 2022 in 2027, probably that will look like a bargain. I have no crystal ball, but with all indications, it will look like a bargain.
I agree with you, Alex. So with this, continuing with my example, like, again, I just use straight line method. The value is 990,000. You're after 600,000 you borrowed, your balance is 520. You got 472,000. Well, we did some predetermined math at the beginning. We knew after 8 years, your balance would be just a little more than 299,000. You take that profit less your mortgage that you need to pay off in your home, and now you got a surplus of $173,372. A lot of people might be wondering, like, well, what about the cost of selling it and any taxes, the capital gains involved with it? I'm not an accountant, but I'm pretty sure $173,000 is a lot of money to cover all those expenses. There may even be a small surplus on top of that.
Yeah, so a significant part of that will be a surplus. Yeah.
So it just, there's to pay off your mortgage faster. There's this. Everyone talks about the first 3 common things that I talked about at the very beginning.
Mm-hmm.
This is thinking outside the box. How do the rich get richer? Well, the rich leverage. They leverage their home, they leverage their businesses, they leverage into good long-term investments. And real estate is a long-term investment. It's not I got very lucky when I was able to take equity out of my home after like 18 months. The reality is you're not everyone's, that's not going to happen all the time. But if you give it 8 years, which is a reasonable amount of time, you'll do fine. The more time you give it, the more profit you'll probably have. So this is one of my hidden secrets, Alex. What do you think?
That's a good one. That's a good one.
Thanks.
Yeah.
Now, before I start answering any questions, I'm not sure if there's questions yet. After we did all these calculations, you really got to, okay, we did the calculation, we did the math. You got to go and buy the property. Because again, we could do the theory, but until you buy the property, that's when the reality kicks in. Now, number one thing we hear, Alex, with investment properties in Toronto, cash flow negative. Right?
Yeah. There's no cash flow positive properties in the GTA.
Well, the solution for that, again, when you first got your property for 5 years, you accelerate your mortgage payments, and you make lump sums on your mortgage. If you reduce that payment on that mortgage from $1,600, you could reduce the payment down to $1,226 a month. Oh, sorry, biweekly. That saves you $810 per month. If you stop making these annual contributions, lump sums, that puts another $416, per month in your bank account. Now, for property that may be cash flow negative, where's the money going to come from? Boom, it's there. You got an extra $1,226 to cover any expenses in a property. It depends on where you're buying and what you're buying, but if it's cash flow negative, we just freed up $1,200.
So after you took the equity out, you bought an additional property. That's when you would scale all of this back.
Scale everything back. Stop putting the annual lump sum payments, because again, if in today's market with today's interest rates, if it is cash flow negative, we got to see how much it's negative. But the question is always, where's the money going to come from? Well, you already have the money. Just make changes to what you already have. It's not like when you have this investment property, you're going to hold it forever. And when you lower your payments, it's not going to be forever. It's because we have an end goal. The end goal is we hold this property for multiple years. So you could have a time frame of 8, you could have a time frame of 10 years, you could have a time frame of 15 years. So maybe you want a larger surplus for retirement. Making those changes, think of what's going to happen 8, 10, 15 years from now. What the results are going to be.
So the way that I see this, kind of like how this and correct me if I'm wrong. So, you accelerate your payments, you start putting down lump sums, you're trying to build that equity as quickly as you can in your property. Now, after, let's say 5 years, once your property or whatever, after a period of time, once you've accumulated that equity, now you use that as a down payment towards purchasing another property. And then to offset that property, like if let's say it's a condo in Toronto, it's going to be cash flow negative, then you basically scale everything back. And by that time, you've already made a significant dent in your original mortgage. And you're also used to these new higher payment amounts.
Now you have 2 properties increasing. Alex, you're well said. Again, you pretty much got it all right.
Mm-hmm.
Because again, you need to scale back. You only have so much money coming in. You have to make sure you balance, right? So scaling everything back, again, there's no rush to pay off that increase in your payments anymore, because you have another property, someone else paying that mortgage, paying that principal down, that other property also appreciating in value.
Yeah.
Where down the road, you're going to get that large lump sum to pay off whatever you have left.
Yeah. And, now we're in an environment where interest rates are pretty high. We're probably not going to be in that environment in the future. Nobody, again, has a crystal ball to predict that. But then also, like, it's something that when, somebody goes to renew their mortgage, or they're renewing at a lower rate, now they're not as cash flow negative. Maybe they can start to scale these things up to start building equity again.
Well, the equity is going to be happening because every payment's still paying down principal. But you're right, Alex. Again, this example is based on an interest rate of 5.49%. Well, I wonder what the numbers would look like if the rates went down by 0.5% or 0.75 or 1%, right?
Yeah.
It changes the dynamics quite a lot. The principle is still the same. Like if it works in this high rate environment, well, clearly if rates went down, it's going to be in your favor.
Yep.
So this is the first hidden secret. And this is something I personally do, because now I have an investment property. I partnered with 2 other people when I bought my investment property. So I share the cost and we share the gains. But at the same time, it's something that, I'm doing to help me pay off my mortgage faster. Because I don't want to be working for another 20. When I got my mortgage on my property, I didn't want to work for 25 years to begin with to pay it off. So this is one secret. I want to kind of go into hidden secret number 2. Make your equity work. You bought your home a few years ago for 600. Forget about that 6.5%. I just want to use a straight number. Let's just say it's worth 800 today. After 5 years, your balance is just under 389,000. You have $411,000 worth of equity, and equity you have in your home is great. However, it's not earning you anything. It doesn't do anything for you. It just sits there. Doesn't make any money. You have a high net worth. You're worth $400,000, Alex, but can't do anything with it. So one thing I do is I choose to invest using my equity. You could refinance your home. You take equity out, and you have the money that you have sitting in your home start working for you. I do recommend you for doing things like this. You have to work with an experienced, qualified financial advisor to invest your money. So you can take money out to invest. At the same time, you need to speak to a CPA accountant to understand your tax saving. Everyone focuses about, how much extra tax I'm going to pay. There's also tax savings involved with this. And I don't want to go into too much with regards to specific investments or taxes because I'm a mortgage broker, not a licensed accountant, not a licensed financial advisor. But I will be sharing a few things. So the first, Alex, again, for every $100,000 in your mortgage, you increase it. And I'm going to use a 100,000 example. You can refinance, take 100,000 out, 150. You may have a lot of equity in your home. You may want to take out $500,000. I look at it this way. So I take out $100,000. I'm paying 5.49%. And again, you can actually amortize your mortgage over 30 years to have the lowest payment. So on that 100,000, Alex, I have a monthly payment of only $563 per month. Now, what I do is, again, I work with a certified financial advisor. I invest $100,000 in a portfolio of items, and my portfolio earns 8.5%. And it's a combination of interest, distributions, dividends, option premiums. I really don't want to go into all these investments. I invest in private mortgages, so many different things I'm not here to talk about, but there are ways of earning more than 5.49%. You don't necessarily have to earn as high as 8.5. The point is, if you could earn more than what you're paying. With this example, on the $100,000, I get an average monthly income of $708 per month. So that means every month, Alex, I got a surplus of $145, $1,700 per year.
The spread. You're living in the spread.
Yep. I find tools with regards to, I have so much equity in my home sitting there doing nothing. I want to earn something for me. And I'm doing this based on a high interest rate environment. Again, rates go down, investment returns may come down as well, right? I just look at what spread can I get on my money to make me more money. And this is just an example. In this example, $145 per month. Now, doing $145 per month is not going to break the bank. Not going to make me pay off the mortgage that much faster, but it's at the end of the day, Alex, it's my equity is starting to work for me. I don't have to work those extra hours to make an extra $145 a month. Money is working for me.
And I mean, that 8.5%, it's so reasonable. Like, yeah, definitely, work with licensed, accredited investment specialist to invest your money. But I'm just looking at an ETF, like the iShares Core S&P 500 Index ETF.
Yep.
And, basically, the total return in the last year was 30%.
Well, that's this where, again, doing this again is long term. Now, again, S&P is clearly diversified, right? Yeah. We're not here to give an investment, but again, I earn interest, distribution, dividends, option premiums, also, I should have put in there also, I guess the interest is private mortgages, right? You can invest in a mortgage investment corporation, earn interest from there. I like to have it diversified because even the S&P could have its good years and bad years, right? And S&P, I don't think it pays you every month or every 3 month money, because I need money, Alex, to make that mortgage payment to 563.
No, you'd have to sell shares, and yeah, in 2022 it did go down 12%. So
yeah, so again, I've worked with different people. Some people have strategies, they want more capital gain than interest. They're willing to make those payments on their own. I like it more of, the rich dad, poor dad. I'm borrowing X amount of money at 5.5. I need to earn more than that. I consider it an asset when I earn more than what I pay. I consider it a liability if I'm paying more than what I'm earning. So there are options and tools working with, if smart people. If anybody needs help, getting access to some of these smart people, send me a message. Let's talk about what your goals are. Because again, you gotta have that mindset. If you're doing this for 10,000, 20,000, it kind of doesn't work. You gotta say, the 100,000 kind of like the minimum. You got to be putting these investment portfolio, having a diversified portfolio. It's really hard to do when you have a small amount of money. But with this, again, Alex, I'm doing this for 10 to 15 years because the market will go up and down over the 10, 15 years. My capital does fluctuate a little bit. But over the 10, 15 years, looking at just the spread, I got, $17,400 of extra money, or $26,100 if it's 15 years. Sometime in the next 10 to 15 years, I will close my portfolio. I'm not looking to make massive profits, right? As long as I get that cash flow, and it's cash flow positive, and I get a slight profit, 10,000, 15,000, I'm cool with that. I'm not here to, have that. I'm not here to max everything out, because then it may come on with additional risks that I'm not accustomed to. So as I do this every month, I got extra cash money coming in. I use it to pay off my mortgage, and then in a few years from now, as I continue doing this, I'm gonna decide, what, I'm done with this. Sell my portfolio, take the small gain. If I'm fortunate, maybe the gain will be higher. The way that my investments are worked out, I try to keep the capital preserved, and I'll just take that little surplus to put an extra lump sum. So that's the second way, if you don't want to buy real estate, how to pay off your mortgage faster. Let the equity in your home work for you.
I like it.